There is a pattern in silver that has repeated without exception for 45 years. Curious. Every single time silver entered a structural bull market, every single time, this one signal appeared before the biggest moves, without exception. 45 years of data. And that signal just triggered 3 days ago. I am going to show you exactly what it is. But first, I need you to understand what is happening in silver right now, because the mainstream narrative is completely wrong. Sarcastic? The headlines are telling you silver is crashing, that the precious metals trade is over, that the smart money is getting out. Silver closed this week below $68. It has fallen over 40% from its January peak of $121. And every financial pundit with a microphone is telling you this is the end. But here is what those pundits are not telling you. The 45-year signal I just mentioned has now fired. And every single time it has fired in the last 4.5 decades, silver was higher, meaningfully higher, within 18 months. Not once has it fired and been wrong. Not in 1993, not in 2001, not in 2008, not in 2016, not in 2020, and it just fired again. Today I'm going to show you exactly what this signal is, why it works, and what it means for where silver is going from $68. I'm also going to show you 3 data points about the industrial demand for silver that will change the way you think about this metal permanently. Stay until the end, because the 3rd data point is the one that the mining executives themselves are talking about in private. And almost nobody in the retail investing world has connected it yet. Welcome. Hit subscribe. Drop a comment. Tell me, have you been buying this dip or waiting on the sidelines? Let's get into it. The 45-year signal. Let me explain exactly what this signal is. It is the relationship between silver and the gold-to-silver ratio combined with a specific condition in the silver futures market. Stay with me here because this is not complicated once you see it. The gold-to-silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Right now, with gold at roughly $4,180 and silver at $68, the ratio is approximately 66. That means 66 ounces of silver buys 1 ounce of gold. Historically, when this ratio spikes above 65 during a period when both metals are in structural uptrends, it has consistently marked a point of extreme relative undervaluation for silver versus gold. Because what the ratio is telling you is that silver has been sold down disproportionately relative to gold. The ratio spiked to 120 during the COVID crash in March 2020. From that extreme, silver outperformed gold by nearly 4-to-1 over the following 18 months. The ratio spiked to 93 during the 2008 financial crisis. From that extreme, silver went from $9 to $49. A 5x move versus gold's 3x move over the same period. The ratio spiked to 80 in late 2018. Silver subsequently outperformed gold by 3-to-1 in the recovery. Every single spike in this ratio above 65 during a structural precious metals uptrend has produced silver outperformance of 3 to 5-to-1 relative to gold on the recovery. Every time, the ratio is currently at 66 and climbing. That is the first part of the signal. The second part is in the futures positioning data. The commitment of traders report, the COT data, shows the positioning of commercial traders, the large speculators, and the small speculators in the silver futures market. Commercial traders are the refiners, the fabricators, the industrial users, the people who actually use silver for real-world purposes. When commercial traders move to a net long position, or even reduce their typical net short significantly, it is because they are locking in prices for future purchases. They are saying, at this price, we want a secure supply. That is not speculative positioning. That is industrial demand signaling that current prices are attractive relative to what they expect to pay in the future. The COT data released this week shows commercial positioning at the least bearish level since November 2022. November 2022 was when silver bottomed at $18 and began its run to $121. The 45-year signal is the combination of a gold-to-silver ratio above 65 during a structural uptrend, plus commercial traders signaling real demand at current prices. It has fired, and it has never been wrong. Why this crash is completely different from 2011. Now let me address the real fear in this market, because the fear is not just about this crash. The fear is about what happened after 2011. Silver hit $49 in April 2011 and then spent the next 8 years declining to $14. That is a 71% decline over 8 years. If you bought silver at $35 in 2011 thinking it was a dip, you watched it fall for half a decade. That experience scarred a generation of silver investors. And right now, with silver falling from $121, every one of those scarred investors is asking the same question. Is this 2011 again? I am going to tell you exactly why it is not, and I am going to show you the data. In 2011, the silver price was driven almost entirely by investment demand, ETF inflows, coin buying, futures speculation. Industrial demand for silver in 2011 was roughly 486 million ounces per year. In 2011, solar panel production consumed approximately 35 million ounces of silver. 35 million. That was the entire solar industry's silver demand. Do you know what the solar industry consumed in silver last year? Over 230 million ounces in 1 year. From 35 million to 230 million in 13 years. That is a 6.5x increase in just one industrial application, and the projections from the International Energy Agency show solar silver demand doubling again by 2030. In 2011, electric vehicles were a science experiment. Silver demand from EVs was essentially zero. Last year, EV production consumed over 90 million ounces of silver. This year, it will be higher. In 2011, AI data centers did not exist as a meaningful economic category. Today, the silver used in high-frequency electrical connections, thermal interface materials, and advanced semiconductors for AI infrastructure is a growing line item in every silver demand forecast. The structural industrial demand that underpins silver today did not exist in 2011, when the 2011 silver price was driven by investment speculation and that speculation unwound. There was no structural industrial demand to put a floor under prices, so silver fell 71%. Today, the industrial demand is real, it is growing, it is not going away, and it cannot be satisfied by existing supply. That is not 2011. That is categorically different from 2011. The 3 demand data points. I promised you 3 industrial demand data points that will change the way you think about silver. Here they are. Data point 1. The silver content per solar panel has not decreased as technology has improved. It has increased. This is the opposite of what most analysts assumed would happen. The assumption was that as solar technology matured, manufacturers would engineer silver out of the panels and replace it with cheaper alternatives: copper, aluminum, other conductive materials. That did not happen. Instead, the new generation of high-efficiency solar cells, the TOPCon and perovskite cells that are replacing the older PERC technology, require significantly more silver per watt of generation capacity. The most advanced TOPCon cells use approximately 20% more silver per panel than the cells they are replacing. And the industry is transitioning to TOPCon as fast as it can because the efficiency gains are substantial. So at the exact moment global solar deployment is accelerating, the silver intensity per panel is going up, not down. The models that projected silver demand from solar plateauing after 2025 are wrong. The actual trajectory is accelerating demand, not plateauing demand. Data point 2. The military's consumption of silver is growing at a rate that no public analysis is capturing. Silver is used in precision-guided munitions for electrical contacts and initiators. It is used in military communications equipment. It is used in naval vessel electrical systems. It is used in drone technology. Multiple nations are now on wartime production footing for military hardware. The U.S. defense budget for fiscal 2025 was $886 billion, the highest in history. NATO allies are increasing defense spending toward and above 2% of GDP for the first time in decades. Russia, China, India, all dramatically increasing military hardware production. Every one of those weapons programs requires silver. Silver that is used in military applications is not recycled. It is gone permanently. A silver contact in a missile that is used in conflict is not recovered. It is destroyed. Military demand is the most permanent form of silver consumption on Earth, and it is growing at a rate that is not showing up in the civilian market data because defense procurement is not publicly disclosed. The people who study this, the analysts who work with defense contractors, say military silver demand has increased 40 to 60% over the past 3 years. 40 to 60% on a base that was already significant. Data point 3. This is the one the mining executives are talking about privately. India. The Indian market for silver has historically been primarily jewelry and silverware, cultural demand, decorative demand. That category is real and large. India consumes roughly 300 million ounces of silver per year, but it is not the story. The story is what is happening in Indian industrial silver demand. India is in the middle of the largest domestic manufacturing expansion in its history. Prime Minister Modi's production-linked incentive schemes have catalyzed semiconductor manufacturing, electronics assembly, solar panel production, and EV manufacturing inside India. Tata is building EV factories. Foxconn is assembling iPhones in Chennai. Indian solar installation targets have been raised 3 times in the last 2 years. Indian industrial silver demand has grown from roughly 40 million ounces per year in 2018 to an estimated 95 million ounces last year. And the projections for 2027 and 2028, based on the manufacturing pipeline already under construction, are above 150 million ounces per year from one country that was barely a factor in industrial silver demand 6 years ago. Add 150 million ounces of Indian industrial demand to 230 million ounces of global solar demand, to 90 million ounces of EV demand, to 60 million ounces of military demand, to AI infrastructure, to 5G, to medical devices. And then tell me where the supply is going to come from, because I will show you where it is not coming from. The supply collapse nobody is reporting. Let me show you the supply side of this equation, because the demand picture I just described is extraordinary. But the supply picture is what makes this truly unprecedented. The world produces approximately 820 million ounces of silver per year from mining. 820 million. That number has not grown meaningfully in 7 years, and here is the reason. Approximately 70% of silver production globally is not from silver mines. It is from mines that are primarily producing copper, zinc, lead, or gold. Silver is the byproduct. When a copper mine is operating, it recovers the silver that comes out with the copper ore as a secondary product. This means that silver supply is not directly controlled by silver prices. It is controlled by the economics of copper, zinc, lead, and gold mining. And here is the problem. The copper mines that produce most of the world's byproduct silver are aging. The ore grades at the world's major copper mines, Escondida in Chile, Grasberg in Indonesia, Cerro Verde in Peru, are declining as the highest grade ore bodies are depleted. Lower ore grades mean less metal per ton of rock processed. Less metal per ton means lower byproduct silver recovery, even if the mine is operating at full capacity. The copper mining industry's response to declining ore grades has been to process more rock, not to find new high-grade deposits. But processing more rock requires more energy, more water, and more capital. And even with higher processing volumes, the silver per ton keeps declining as ore grades fall. Chile, the world's largest copper producer, has seen average copper ore grades fall by over 30% in the past 20 years. 30%. The silver that comes with that copper has fallen proportionally. And on the primary silver mine side, the story is even worse. The number of large-scale primary silver mines in development globally is near a 20-year low. The pipeline of projects that were in exploration and pre-feasibility in 2018 and 2019, when silver was at $14 and nobody wanted to fund silver exploration, has simply not been replaced. The projects that were canceled when silver was cheap cannot be brought back quickly. A greenfield silver mine discovery today would not produce its first ounce of silver until 2033 at the earliest, more likely 2035. So the supply that the demand picture I just described requires, the extra 300, 400, 500 million ounces per year that solar, EVs, AI, military, and Indian industrial demand will need by the end of this decade, cannot be produced. It does not exist. Not as identified reserves, not as projects under development. It has not been found, and it has not been funded. The physical silver that the world's technology infrastructure will need in 2028 and 2029 is sitting in the ground somewhere, unidentified, undrilled, unfunded. That supply gap is not theoretical. It is arithmetically certain. And the only mechanism markets have to resolve a supply gap that is arithmetically certain is price. Price rises until demand is destroyed or until new supply can be brought online. Given the structural nature of the demand, you cannot build solar panels without silver, you cannot make EV batteries without silver contacts, you cannot guide missiles without silver initiators. The demand is largely inelastic, which means the price has to do the work. And the price has a long way to go. The mining stocks tell the real story. I want to show you what is happening in the mining stocks because this is where the opportunity becomes quantifiable. The silver mining companies that you can buy today are producing silver at all-in sustaining costs of between $14 and $18 per ounce. $14 to $18. Silver is trading at $68. That is a margin of $50 to $54 per ounce. Per ounce. There is no other industry on Earth right now generating margins of this magnitude relative to cost. not oil at 170, not copper at record prices. Silver miners are generating operating margins of 300% on their cost of production. And the market is pricing them as if those margins are temporary, as if silver is about to go back to $20. Look at the valuation multiples. The major silver miners are trading at 8 to 12 times earnings. 8 to 12 times earnings on a business generating 300% operating margins, with a supply deficit that guarantees current prices or higher for the foreseeable future. In a normal industry, a company generating 300% operating margins would trade at 25 to 35 times earnings. The discount the market is applying to these companies, the gap between where they are trading and where their fundamentals say they should be trading, is one of the largest sector-wide valuation discrepancies I have seen in 20 years of watching these markets. And I want to be specific about why that discount exists. It is not because the market thinks silver prices will fall. It is because the generalist institutional investor, the pension fund, the sovereign wealth fund, the large cap equity manager, does not own mining stocks. Mining stocks are not in their benchmark. Mining stocks are not in the S&P 500 in meaningful size. They are not in the MSCI World Index in meaningful size. The average large institutional portfolio has near zero exposure to precious metals mining. And the reason they do not own them is not valuation. It is because they have not needed to own them. For the last decade, technology stocks produced all the returns any institutional manager needed. Why own silver miners at 8 times earnings when you could own Nvidia at 40 times earnings and watch it go up 10x? But something changes when technology leadership falters. When the mega-cap tech stocks stop delivering the returns that have justified ignoring everything else. When the institutions that have been fully allocated to one sector for a decade start looking for where the next decade's returns are going to come from, they are going to look at an industry producing 300% operating margins, trading at 8 times earnings, in a structural supply deficit with generational demand tailwinds. And they are going to ask why they do not own it. And when $1 trillion in institutional assets starts rotating into a sector that is currently worth roughly $200 billion in total market capitalization, the math of what happens to share prices is not subtle. Addressing the real risk. I want to be honest with you about the real risk here, because I am not going to pretend there are no risks. The real risk to this thesis is not Fed policy. It is not the dollar. It is not even the supply picture. The real risk is a global recession severe enough to destroy the industrial demand I just described. If the world economy enters a deep contraction, the kind that stops solar panel installation, stops EV production, stops AI infrastructure build-out, then silver's industrial demand picture changes. That risk is real. A 2008-style global recession would hit silver hard in the short term, exactly as it did in 2008 when silver fell from $20 to $9. But here is what matters. Even in 2008, the silver crash was temporary. From the 2008 low of $9, silver went to $49 in 2011. Even in the worst recession in a generation, the structural bull market was only interrupted, not ended. Because the underlying supply and demand dynamics did not change. The recession delayed solar deployment. It delayed EV adoption. It slowed industrial production, but it did not change the trajectory. And when the recession ended, silver resumed its bull market with violent force. The same is true today. Even if a recession hits, the structural demand for silver from the energy transition and technology build-out is a multi-decade story. A 2-year recession does not change where solar is in 2030. It might push the timeline back slightly. It does not change the destination. And the supply picture, the declining ore grades, the empty development pipeline, the 7-year underinvestment, those are not fixed by a recession. If anything, a recession makes them worse because it further depresses mining investment. The risk is timing, not direction. Direction is clear. Direct, address, and close. Let me speak directly to you. If you are sitting on silver positions that are underwater right now, if you bought at $80 or $90 or $100 and you are watching $68 and feeling sick, I want to give you a framework. Ask yourself one question. Has anything I just showed you changed? Has the solar industry stopped using silver? Have EV manufacturers found a replacement for silver electrical contacts? Has India reversed its manufacturing expansion? Has the mining industry suddenly discovered 500 million ounces of new annual production? Has the Federal Reserve found a way to raise rates to 15% with $38 trillion in debt? If the answer to all of those questions is no, and it is, then the price change does not mean you were wrong. It means the market is giving you a better price to be right. That is not comfortable. I know it is not comfortable. But real wealth is not built in comfort. It is built in moments exactly like this one, when the facts say one thing and the price says another, and you have to decide which one you trust. The 45-year signal I showed you at the start of this video has now fired. The gold to silver ratio at 66 during a structural uptrend has fired. The COT data showing commercial demand at levels last seen at the November 2022 bottom has fired. Every time these signals have appeared together in 45 years of data, silver was higher 18 months later. Not most of the time. Every time. I am not saying tomorrow is up. I am not saying next week is up. I am saying the data that has correctly identified major silver bottoms for 45 consecutive years is telling you that this is a bottom. And the industrial demand story, the 6.5x increase in solar silver demand, the emergence of EV demand from 0 to 90 million ounces, the military demand growing 40 to 60%, the Indian industrial explosion, that story is not in the price at $68, not even close. The window where you can buy silver at $68 will not last. Supply deficits resolve. They resolve with higher prices. The only question is whether you are on the right side of that resolution. Here is your summary. The 45-year signal combining the gold to silver ratio and commercial QOT positioning has fired. It has never been wrong. Solar silver demand is up 6.5x since 2011, and the new TopCon panels use 20% more silver, not less. Military demand up 40 to 60% in 3 years. That silver is gone permanently. Indian industrial demand tripling from 40 million to projected 150 million ounces per year by 2028. 70% of silver supply is byproduct from copper mines with declining ore grades. Supply cannot grow. Silver miners producing at $14 to $18, trading at 8 to 12 times earnings with 300% operating margins. The data is not ambiguous. This is not 2011. The industrial demand that was missing in 2011 is here now, and it is only going up. Drop a comment. Tell me which data point surprised you most. Tell me if the Indian demand story was new to you. Share this with someone who is panic selling right now. They need to see the data. If you are new here, subscribe. I cover the real supply data, the industrial demand curves, the mining sector economics, and the macro forces that are driving the most important commodity story of this decade. Silver at $68. The signal says bottom. The data says buy. See you in the next one.